Making Offset Credit Banking Work. This is the 6th session in the web forum series Land Use 2021, a place for biodiversity offsets, brought to you by the Alberta Land Institute. My name is Dave Poulton and I'm director of the Institute. We are a nonpartisan land use policy research institute based at the University of Alberta in Edmonton, Alberta. We at the University of Alberta acknowledge that we are located on Treaty 6 territory, respecting the histories, languages, and cultures of First Nations, Métis, Inuit, and all First Peoples of Canada, whose presence continues to enrich our vibrant community. In the previous sessions in this series, we've considered how offset projects may be designed to deliver optimal environmental and social benefits. We've also considered some of the pitfalls and complications that we want to avoid when we design offsets project by project. Today, we want to move to a different level of consideration. How can we create offset delivery systems that are efficient while still optimizing the environmental and social benefits and avoiding those pitfalls? One of the mechanisms that's often spoken of in a positive light is offset credit banking. Under banking systems, offsets are created and certified in advance of the negative impacts for which they will compensate. Offset credits may also be transferable, creating the possibility of a market in environmental benefits. Today, we're looking at offset credit banking systems in 3 different jurisdictions: the United States, Australia, and Germany. To lead today's session, I'd like to welcome Amy Taylor. Amy is an environmental economist and consultant based in Canmore, Alberta. She is Director of Operations for Green Analytics and has produced a broad variety of work on the economics of ecosystem services. Amy, welcome. I'll turn the screen over to you.
Thanks, Dave. Hello, everyone, and welcome. As Dave said, my name's Amy Taylor, and I'm going to be moderating today's session. I'm an owner and employee of Green Analytics, which is a small consulting firm that specializes in environmental economics. Since our inception in 2011, we have done numerous projects, instruments for governments across Canada. It is my pleasure to be here today to learn about offset credit banking systems in other jurisdictions and to think about how the experience in other jurisdictions can help inform policy directions in Canada. With that in mind, today's presentation is titled Making Offset Credit Banking Work. As the title implies, this session is focused on offset credit banking systems. Under such systems, credits are created and made available for sale in advance of disturbances. In this way, they are not tied to any particular project, but are banked and can be purchased to offset impacts prior to projects taking place. Today, we are very lucky to have speakers from 3 jurisdictions: the United States, Germany, and New South Wales, Australia. These jurisdictions have offset credit banking systems in place, and our speakers will speak to the experiences of those jurisdictions. I will begin the session by briefly introducing each speaker. Full bios are available lower down on this stage screen. Following my introduction, each speaker will provide a 10-minute overview of offset credit banking in their jurisdiction. I will then ask a series of predetermined questions, which are designed to both highlight some of the differences between the systems across jurisdictions and to help inform policy developments in Canada. The latter part of the presentation will be dedicated to taking questions from the floor. Our first speaker today is George Kelly. George has vast experience related to offset credit banking systems in the United States. Mr. Kelly is the founding member of Bespoke Mitigation Partners, an advisory business and project incubation firm focused on environmental markets and nature-based solutions. He is also the Global Client Strategy Officer at Earth and Water Strategies, with a focus on advising, navigating, and unlocking the value of environmental assets. Mr. Kelly was recently appointed by the US EPA Secretary to serve on the EPA's Environmental Finance Advisory. George will be followed by Conor Gillespie, who will also share perspective on offset credit banking in the United States. Mr. Gillespie is a restoration ecologist specializing in the restoration of aquatic resources. With more than 15 years of experience in stream, wetland, prairie, and woodland restoration, he has worked on permittee responsible mitigation projects, mitigation banks, in lieu fee projects, and programs and ecological offset projects across the United States. His experience includes managing one of the largest floodplain restoration projects in the Northeast US. He is the founder of Catalyst Companies. From there, we will cross the ocean to hear from Professor Marianne Darby. Located in Germany, Marianne Darby is an environmental planner and researcher with many years of experience in landscape and spatial planning. Her research focuses on biodiversity conservation and management, as well as impact mitigation in national and international contexts, sustainable land use, green economy, and market-based instruments. She works as a professor for landscape planning and impact mitigation at Geisenheim University. Our last speaker joins us from New South Wales, Australia. John Seidl is the manager of the Offset Assessment and Systems Unit in the New South Wales Department of Planning, Industry and Environment. John is a specialist in conservation program design and implementation with over 20 years experience working in government and non-government sectors. John leads a team that supports the development and implementation of the New South Wales Biodiversity Offset Scheme that commenced in 2017. This includes development of the biodiversity assessment method and finalization of the New South Wales Biobanking Scheme. I will invite George to join me on the stage to deliver his presentation now.
Greetings all. Thank you to the Alberta Land Institute for the opportunity to be here today to talk about mitigation and offsets in the United States. I send my greetings from the mid-Atlantic of the US, where we are experiencing the 17-year cicadas, which is called Brood 10, and it's quite a spectacle for anybody that has ever seen it. I have had, as Amy mentioned, I've had about 24 years in the environmental ecosystem market space, and also was involved with the mitigation process from its inception. And I'm also recently been involved with efforts in the Yukon on restoration and also stream restoration in Canada under the Fisheries Act. So I'm very pleased to be presenting here today. I'm going to give you a backdrop and a sense of the evolution of the market in the United States. Then I'm going to turn it over to Conor Gillespie, who's going to talk to you a little bit about more details about some of the innards of this process. So next slide, please. So just to give you a bit of a backdrop, and this is based on a 2017 Forest Trends report, but the market for biodiversity offsets is about $5 billion a year. And the United States is about 3.8 billion of that. And you can see a lot of the other countries are a lot lesser. And you're going to hear from others who may have updated information about that, in particular Australia. But suffice to say, it's one of the most robust markets for offsets in the world. We know that there's a tremendous room for growth. We think that a lot of this is process issues that create impediments, and I think this is part of why we're here today. The other point I'll raise is that when done right, you can leverage private capital in a way that surpasses the public investment, and there's a lot of investment capital on the sidelines these days, and I think it's an important thing to recognize. Next slide, please. So let's talk about briefly the Clean Water Act mitigation marketplace for wetlands and stream in the United States. The key aspect, and you're going to hear this from a lot of the speakers, is that there has to be a market driver for the mitigation in the first instance. And in this case, the Clean Water Act, the United States, initially did not have a requirement for no overall net loss, but in 1989 there was guidance announced that talked about no overall net loss of wetland acres and functions, and that was ultimately adopted to apply to streams in addition to wetlands, in light of the definition in the United States of waters of the United States. From 1989 to 95, the mitigation was clearly ad hoc. There was no clear standards on what an offset should look like. There was no clear standard about how you get to no net loss. And in 1995, there was some guidance issued that basically promoted the idea of mitigation banking, which is different, which allowed enterprises to basically mitigate it in advance of an impact, and ultimately have that mitigation bank service the impact. Now, in addition, there was an announcement that there was something called the mitigation hierarchy, which is avoid, minimize, and mitigate, which basically means you've got to avoid first, minimize second, and then only mitigate the residual impacts that aren't avoided and minimized. And those are keystones to the mitigation process. Ultimately, what evolved, it was three forms of mitigation implementation. And you're going to hear more from Conor about this, so I'll give you a brief inputs on each of these. Permittee responsible mitigation is basically mitigation done by a permittee for a particular impact at the time of that impact. Mitigation banks, they're done in advance. They're basically serving multiple impacts. So a bank may not just be for one permittee, it may be for multiple permittees. And then payment into in lieu funds is basically a permittee pays into an in lieu fund that ultimately is supposed to deliver the mitigation in the future. These last two mechanisms, mitigation banks and in lieu fees, are referred to as third-party mitigation because the liability is transferred to that enterprise to deliver the mitigation solution. In 2008, what I think is one of the most seminal pieces of law that occurred in the United States was the new regulation adopting what we call the federal mitigation standard. And in that instance, it created a preference for mitigation banks. And next slide, please. And then it set forward 12 steps for any mitigation project, whether it was permittee responsible, whether it was a mitigation bank, or whether it was an in lieu fee. And as you can see from the 12 steps, you had to state your objectives. You had to have the right site selection. For example, if you were identifying a site that couldn't be restored, then it was inappropriate to suggest restoration. You also had to have a site protection instrument that is determines how the tenure of your protection. In the United States, it's permanent under the Clean Water Act, so that you had to have a permanent easement or a restrictive covenant. You had to have baseline information. You had to show what the site was before you did the work in order to enhance the functions, ecological functions. And the baseline report is very important. Then you had to have a determination of credits. And I think this is important. Clearly, you're going to hear this as well. And I think this is a key issue about how you convert your work into a credit. What activities convert into a credit. In the United States, they allow for regional variations. So we have a lot of different states having their own credit approach. But if you have a project within that state, there will be consistent crediting. You have to have a mitigation work plan. You have to have a maintenance plan, performance standards. How are you going to achieve these objectives? Typically in a wetland, it's both hydrology and vegetation. Monitoring requirements. You have to monitor to make sure you're going to achieve those performance standards, and that can go anywhere from a 5 to 10 year requirement. And then once you complete the initial monitoring and have achieved your performance standards, then there's a long-term management plan that basically just assures that that property remains intact and is not subject to trespass and other items. You have to have an adaptive management plan, and then finally, financial assurances typically are imposed at the time that you enter into a mitigation work plan. Next slide. So what are the key elements? I think you're going to hear some take-homes, but again, the clear policy goals and strict enforcement. The idea of this no net loss was a keystone to drive the mitigation in the first instance. But as I mentioned to you, if you didn't have standards that set forth how you get credits and debits, how do you determine the mitigation approach, then you're going to create an ad hoc system. So this idea of uniform mitigation standards within the regions was also a significant, important issue. Then having a certification process of this mitigation is also key, because that enables the buyers to understand, particularly when you're talking about third-party mitigation, that the mitigation is basically released and acceptable to the resource agencies. Other points include that if you have mitigation standards that are too complicated, that are tied to too much science, a buyer and a seller can't interact. It has to be simplified in a way that people can understand it. And there has to be permanency here in the US of the land protection, but in other areas, sometimes there has to be some land protection tenure. And then finally, in third-party mitigation, as I mentioned earlier, this transfer of liability, the sponsor of that particular project takes on the liability for success in meeting the performance standards. Next slide, and my last. So this is just to give you a flavor. These are stream banks. These dots, it's a little bit outdated, but these dots represent stream mitigation banks throughout the United States. Couple points here. You just notice that a lot of the banks are in the Southeast. That tends to be where the resources are located. But it also reflects the type of rules in each of those states. These states have rules that promote mitigation standards and the like. So, so with that, I'm going to turn it over to Conor Gillespie of Catalyst Companies, and he's going to give you some more in-depth analysis of the U.S. market.
Afternoon, everybody. It's a pleasure to be here today. Appreciate your time and looking forward to talking to you about this. As George said, what we're going to do is take a little bit of a deeper dive on some of the topics that he just talked about. We'll start talking about the different ways that you can implement mitigation, and then we're going to go to kind of a higher level, at least based on our experience, what we've seen in the market that works well, that doesn't work well but isn't too bad, and then what just really doesn't work well at all. So starting with the different types of mitigation from an implementation standpoint, as George said, within the 2008 rule, they outline mitigation banks in lieu fee and permittee responsible. If bank credits are available, those should be the first choice because the work's already been done to generate those credits. In lieu fee should be the second choice if available, because the idea there is that they're going to aggregate all those credits and they'll be able to do larger, more significant, more robust, and more sustainable, ultimately, projects by aggregating all those impacts into a single area and then doing the mitigation, or under a single entity, I should say, excuse me. And then lastly, permittee responsible. So we'll talk briefly about the pros and cons of those. Mitigation banks, there's sort of within the industry two ways to think about those. One of them is just a standard mitigation bank where you generate credits and sell them to any buyer within your given service area. And so some of the benefits of that, the temporal loss is relatively minor. The work has to be done in advance of generating the credits. The banker holds the liability, which the permittees really, really like that. It's a huge benefit to them. And what it also does, which is economically a very good thing, is that it allows for fast permit review for the impact project. So the regulatory reviewer knows that the credit they're purchasing has already been approved, it's already been generated, and it takes a pretty significant potential delay out of the implementing party's permit review process. Because the liability transfers and because of the amount of capital that goes into financing and getting a mitigation bank up and running, they tend to be higher priced because the banker's taking a lot of liability and is taking a lot of risk on behalf of all the people who are buying credits from them. So there's also an option to do a single client mitigation bank. You'll see departments of transportation do this a lot. They know that over the next 10 to 15 years, they're going to need X amount of credits in a given area. So they'll go in and they'll make a bank for themselves. And that can actually be very cost effective because you know what you're going to be offsetting, so you can size accordingly. You know that you've got demand coming down the pike, and you know the entity that you're working with, so that can take that and it can de-risk it a lot from the stance of the banker. In lieu fees are a very different beast. So they're essentially, they get a large portion of credits released in advance, and when they get those credits released, this is really important to understand, at least the way it functions here in the US, they have to set their credit pricing. And so one of the issues is that sometimes you have people who aren't necessarily experienced in implementing these projects being given a lot of credits that they haven't had to do the work to generate yet. And then they're just based on their best understanding setting a credit price. And we'll get into this more in the next slide, but this can create some really negative market incentives if it's not managed pretty closely. A lot of times you'll see in the fee programs set their pricing wrong, and 3 to 4 years into the program, they have to adjust their pricing, and usually they have to increase it. And we'll talk about what some of the implications that can have is in the next slide. The other thing is temporal loss with in lieu fee programs can be very significant. They're supposed to, in their instrument, say how many years it's going to take them to get projects in the ground once they collect revenue for that, for those impacts. Usually they'll say somewhere between 2 to 3 years from revenue collection to getting the project in the ground. That tends not to be the case. Most of them take 5 to 7 years to get that implementation done after they've collected revenue. And so you end up with very, very significant temporal loss a lot of times under an in lieu fee program. And they're very varied across the country. They can be done by government agencies or they can be done by nonprofits. And so there's some really good ones, there's some not so good ones, and there's some that have gotten in trouble in the past and ceased to operate. And so lastly, there's permittee responsible. The liability stays with the permittee under a permittee responsible mitigation. You're not generating actual credits that you can sell on an open market. You're generating, essentially you're using the same protocol that's used for mitigation banks or in lieu fee programs, but you're generating what needs to be generated to offset the impacts of the permittee. Permittee maintains that liability. Again, it's a very targeted approach. You're doing just what's needed, usually nothing more. So it tends to be within the moderate price range. And for large projects, permittee responsible can still be a good option. You can do very good, very large permittee responsible projects. Where they really tend to get into problems is when you do these small, tiny permittee responsible mitigation projects. And when they did the 2008 mitigation rule, they went back and looked at a lot of those projects that had been done in the past. And they found a lot of issues. They were overrun with invasives. They didn't hit their performance standards. They weren't under protection, or people just forgot they were there and then impacted them again. So what they really want to avoid is those small permittee responsible mitigation projects, because they showed that in the long term, they just weren't very successful. So moving from there into some of the dynamics of how that sort of interchanges and interfaces, if you will, with some of the other market factors to consider as you think about setting one of these programs up and what that can do. And this is all, I should say, slightly subjective. I think different people in this industry, one of the good things about it is that we're dealing with things that people are passionate about. But one of the things that can be challenging is there's a lot of different opinions, and there's some conflicting science arguably right now as to what is good quality, what isn't good quality, what should the goals be, what shouldn't the goals be. But as you're contemplating a program, it's really important to think about how all the rules and regulations you set are going to influence both the quality and price of the product that you're going to get put onto the market. The main takeaway, the number one thing, and George mentioned private investment. And so if you're going to set a program like this up and you want to set it up in a way that will drive private investment into the sector to get good restoration in the ground, you have to provide regulatory certainty. There is nothing that will kill a discussion with a potential investor or people looking to invest in this market like saying, yeah, we're going to get a permit. It might take us 6 months. It might take us 3 years. We're not sure because the regulators are all over the place. It's impossible to run a good pro forma in that scenario, and you just won't drive investment. We talked about this a bit on the last slide, but in lieu fee programs should be the ceiling. They should not be a floor, because essentially the banking market has to play below that. And so if an in lieu fee price is set too low, then a banker goes in and tries to set a price higher. A person who has a permit is going to say, why am I going to pay a banker more when I can pay an in lieu fee program less? And they get all their credits released in advance. And so even though they haven't shown that they necessarily have the ability to execute, they can create negative incentives on market pricing because the bankers had to produce to get to the point where they're generating credit. So they have a better idea of what their cost of production is, but they're going to be limited by where that in lieu fee price is. And so a lot of those programs take temporal loss into consideration, and they'll adjust the amount of credits that are needed for in lieu fee purchases because they know there's temporal loss. But as we said, usually what they say their temporal loss is going to be versus what it is doesn't match either. So it's an artificially low price point, and really that needs to be the ceiling. And if you do that, and if you provide regulatory certainty so that people know when they can get their permits, when they can get their credits released, you will see private investment come into the market. You will see those bankers generate and compete with each other, and that will create your market floor, which is ultimately what you want. And I've seen that happen in markets where it drives very, very cost-effective pricing on behalf of the permittees. Goals and metrics, George talked about this briefly, but and this could be an entire presentation and discussion in and of itself. Keep it simple. As George mentioned, a lot of different states have different functional protocols. They're supposed to monitor the functions and values that these ecosystems provide. The vast majority of the ones that we've worked with, and we've worked with a lot of them by now, are arguably overly complicated. They take a lot of subjective measurements of what's the quality of the stream, what's the quality of this wetland, and they spread that across different functional groups. And then they aggregate them into numbers, and they take averages, and you have to do it for each stream reach. One project we worked on, we had 500 different calculation sheets to end up with our total credit generation. And when you take that many numbers and just start averaging them, you end up with a pretty normalized distribution curve. And it doesn't really do a lot to get to the specific goals that you're trying to measure. So again, this could be an entire presentation in and of itself, but keep it simple, make it easy to understand. And if you're gonna go down the road of making it more complicated, try to base it on actual measurements of something in the field rather than subjective measurements that are turned into numbers. Be adaptable with your program. It's not going to be perfect right out of the gate. And actually, that's one of the things that's under the bad category. Perfect versus good. You know, let yourself start the program, start in a safe place, and then adapt from there. One of the things that can kill this, again, under the bad, the perfect versus good, is you can't regulate every scenario. And that's one of the problems I've seen regulators get into, is that they have a banker who does something they don't like. And so they try and change the regulations to cover that. And they end up with really cumbersome, difficult regulations that nobody wants to invest in that market because it's too cumbersome at that point, rather than enforcing on the negative actor. And we'll touch on that point again, because enforcement, George mentioned it, it's just key. And I think it's one of the things that's probably lacking. You can also get into problems with regulatory overreach and what I call bioeconomists. So regulators sometimes try and set regulation to limit the amount of profit that a banker might make. They shouldn't even be thinking about that. They should be thinking about what are the outcomes we want, and then let the market take it from there. A lot of the people who are setting these things up are trained as biologists, not as economists. And so you start to get biologists trying to play economics, and that's not always a good outcome. We've worked with some clients where we did some analysis for them. They didn't like the price point they saw, and so they said, well, we'll generate more credits under this protocol to make up for that. And what it actually did in further analysis would actually reduce the amount of mitigation that went into the ground, because if the same site just generates more credits and those are selling against the impacts, you're essentially just getting less mitigation. So you have to be careful about how you structure those things and be very thorough and thoughtful. Bad metrics and bad goals, again, I can speak forever about this, but essentially an example of that, in one district, they had 20 different invasive species that they wanted at 0%. While admirable, not very realistic. And honestly, is that really what we're trying to measure for? A lot of these invasive species are here to stay. We need to keep them at a lower percentage. But there's other outcomes that I would argue are much more significant that we should be measuring out of these projects. Grandfathering without sunsets. So as these programs are adaptable, as they should be, there's an example, an area we're looking at where somebody came in the early days, they developed a massive bank, it created a ton of credits, and then the regulators didn't like what they see. They changed their functional protocol. Those are all good things, but there wasn't a sunset on the grandfathering provision for that old big bank that had generated all those credits. And so no one can really go into that market and do a competitive bank against them until all those credits are sold. And they generated so many that it's probably going to be another 5 to 10 years before that happens. So that market is essentially stuck in its development because there is no sunset on that grandfathering provision. Again, this goes back to regulatory certainty. If you're going to make a change to your program, allow them to grandfather, but give it a sunset clause, 5 years, 7 years, something like that. And sort of the ugly is, nothing kills the development of a market like regulatory uncertainty. If people don't know what's going to happen, how can you expect them to invest significant sums of money in developing these projects? So we're actually looking at this right now where there's a state where we know we want to be in 2 different watersheds. We know that we're going to get a regulator who's going to follow the time frame in one watershed, and we know we're going to get a regulator that isn't probably going to follow the time scale in another watershed. We're going to start in the one where we know we have certainty, because that's where we can most accurately run our pro forma. And eventually we'll go to the other one, but it's going to be later in process because there's more risk associated with that. And then in lieu fee floor, we talked about that, and bad goals, we talked about that. Those can really just create negative incentives that have a negative income, not only on your price, but ultimately on the quality of the restoration that you get in the ground, which I think most people who are in this industry would agree that if we're going to do this, we need to make sure that the restoration that's being done on the other side of the equation is as high quality as possible, given our best understanding of the current science. So appreciate talking with y'all today. And from here, I'm going to introduce Marianne and Darby, who's going to take over.
Hi, everyone. Thanks, Conor, for giving me the floor. We'll now in a bit see my really one screen. I've really prepared only my one slide. I've prepared only one slide sort of as a walk you through the things that I want to say. I have some more in-depth information compiled for you and a couple of more slides or in a short presentation that we can share afterwards, but I really want to summarize for you now some key points on offset credit banking in Germany. Now, for the very basics of this, I would like to give you a little bit of background. This originates from our German impact mitigation regulation, which is based on our Federal Nature Conservation Act and dates back to 1976. So that's quite a long-standing experience that we have with this system. And the important things about this is that it applies for all impacts on all scales and is not restricted to specific areas. So this is really also what we sometimes call the ordinary or everyday landscape that is considered here. And it's also not dependent on a specific size, so it can even be for very small scale impacts. And one very important feature is also that it has a very broad scope, ranging from abiotic features such as soil, water, but also on, of course, the flora and different species, but also the landscape scenery and recreational function for human use. So that's a very challenging and broad scope that this impact mitigation regulation has to fulfill. And it also, like in the US system, applies the mitigation hierarchy with the steps of avoidance, minimization, and compensation. And in the first step, as I said, it originates back to the 1970s. There was no banking. So why did offset banking ultimately emerge? And this started in the 1990s. And we're now a very, let's say, global audience here. And the conference is based, even though it's virtually, in Canada. So the spatial dimensions that we're talking about in Canada or the US as compared to Germany are very different. So in terms of spatial size, Germany is comparably small and has a very high land use intensity and also land use pressure. So when this all started, it was basically due to the fact that as we are in a highly used cultural landscape in Germany, there was a lack of land to actually implement compensation measures. So there was a considerable deficit in the actual implementation of offsetting measures, which until the 1990s were only carried out as one by one compensation measures. So in the 1990s, it started with local authorities, which for their building plans try to go a new way. And in the first step, they did not really set up offset banks, but they first pooled together land that could be later on used for offsetting purposes. And then in a second step, they started with this procurement of measures that were implemented in advance, but still this was in the beginning for the own needs of local authorities for their own building and infrastructure needs. And it was only after that in the 2000s that this was also opened to others, and that third-party offset credits emerged, and we most commonly call these compensation agencies that take over the role of those offset credit bankers. So meanwhile, and this was done in the 2000s, this also is increasingly regulated, and not only at the level of our Federal Nature Conservation Act, which I said is the very basis for everything, but also in the nature conservation laws of the German federal states, because Germany is federally organized, and so the competences for the implementation of these offset credit banking is under the is at the level of the federal states. So they have put specific provisions in the nature conservation laws of this individual federal states, and also issued compensation ordinances and metrics. And one difficulty with this is that due to the federal organizations, we have a system which is very diverse. So this so I can refer or relate to the problem that also Conor has mentioned earlier, that it's really tricky when there are different offset implementation systems or methodologies in place. This is something which is actually happening in Germany, and which is sometimes in practice really hard to oversee. So how does it work in practice? Anyone can offer or can create offset credits, but these have to comply with the named regulations, and they have to be approved by the nature conservation authorities. So they have to be approved, and in addition, they also have to be registered to make sure that these credits are only used once, and that they are carried out according to the provisions of the specific state. So this is a little bit on the system and what it works, or what it looks like. And I would like to briefly come to some, or I already started to mention some of the risks associated. One really big risk that one should try to avoid from the very beginning is to have uncertainty. Conor has also mentioned this, that regulatory uncertainty is actually very bad for a market and also for practitioners. So you need to have very clear very clear regulations, and if you put in place a methodology, then this should be really transparent and applicable for everyone. So that's the first point that is actually problematic when not taking care of this transparency for everyone. One issue that has also been, especially in the beginning, a problematic point was that we've seen with the emergence of the first offset credit providers quite some speculation and people going onto this market that had no clue about economics. Some even did not have sound understanding of ecologics. So the issue of really knowing your business is quite crucial. So how in Germany this is solved now is that we have a more or less regulated market with oversight of the respective authorities. I've mentioned earlier that any credit has to follow the provisions set out in the nature conservation laws, and more importantly, they have to be approved by the nature conservation authorities. But still, the issue of advance financing is somewhat an issue. This has partly been, so the financing of measures before, of course, before they are sold. And this has at least partly been solved by now over the time, the emergence of more specialized offset providers that in some very successful cases are partnering also with the local nature conservation authorities to really combine both economic but also the local ecological expertise. So another issue is the perpetuity of measures, but this applies both for the usual one-on-one offsetting implementation, but also still for offset banks. In Germany, we have the practice that offset measures shall be guaranteed for in perpetuity. However, in practice, this usually means something like 25 to 40 years. To date, there are still, even though the system is quite mature, there are still no long-term results on what really happens after this time. So the perpetuity of measures is really an issue that even under the German system could be tackled better. And the one additional risk that is also being seen, which is, let's say, the backside of a potential, meaning that you can, of course, by creating offset credits, implement more ambitious measures that otherwise would be very difficult or too costly to implement, like, for example, desealing of, for example, old stables in the agricultural landscape and so on. But usually, as these more costly measures are also very intense nature conservation measures, usually will mean that these will be implemented on a smaller area than a potential impact. This then risks to, as I framed it here, to lose area. So in the end, to of course have high quality nature conservation measures and generate credits here, but in the overall balance in the landscape, and as I said, we're speaking here about the whole ordinary landscape, that you might lose natural areas. So before coming to some key factors to success, let me briefly mention some of the potentials that we've seen with the German system. We've seen that with credit banking, and most notably, as I've mentioned, there are now some more specialized offsite providers, the so-called compensation agencies. They really apply an active land management. As I said, we have a high land use pressure, so need for land for different purposes, for building, for agriculture, for compensation, and an active land management offers the possibility to negotiate over land before this high land use pressure gets too heated, so you can plan long in advance, and this can create benefits for all. Another very crucial aspect is the possibility to actively use landscape planning and to focus on conservation targets, to focus especially also on strategic conservation targets, and to embed these habitat banks into, for example, biotope networks, and creating a green network really that can gain an overall greater benefit for nature. So, and I've already mentioned that you can, of course, with specialized offset providers, also implement more ambitious measures in terms of trading up. So finally, some factors that we've seen that are really crucial for offset credit banking. As I've said, you really need transparency for everyone. So this refers both to clear regulatory guidance for everyone and a clear methodology, but also transparency on the measures and on the implementation and follow-up of the measures, and therefore such a registry of measures is really crucial, and ideally such a registry should be accessible to the public. A second point that is that applies to offsets in general, but is even more important when dealing with offset credit banking, is to keep in mind the spatial limits, because when you decouple offsets from the impact, then you might even more get a segregated landscape, which ultimately you do not want. So what let's say the solution in Germany is that you really try to keep in specific landscape units still sort of a spatial connection between impact and offset. So say that you cannot have an impact somewhere at the coast and have an offset somewhere really in the mountains. So there's really still this spatial connection between impact and offset, also to consider social equalities or inequalities is quite crucial. And this brings me also to another important point, to take local or regional stakeholders on board. This can help you, together with an active land management, with farmers, but also with the local population, to potentially also build ownership for these measures. And this really fosters or supports the implementation and also the perpetuity of measures. And one last point that cannot be said enough is really you need trained professionals. So as Conor has said, really you need biologists, but you also need economists, and you need to bring this expertise together on these 2 points. And this also needs to be grounded in the local circumstances. So that's, I apologize, I've already spoken a bit too long. That's in a more or less in a nutshell what the German credit banking system looks like and what conclusions can be drawn from it. And now I would like to hand over to John to hear from Australia.
Thanks, Marianne, and hi everyone. I'd just like to begin by acknowledging the Awabakal people as the original custodians of the land from where I'm speaking from, which is in Newcastle in New South Wales, and just pay my respects to elders past, present and emerging. I'm just going to speak to, I've just got the one slide, so I'm just going to speak to some of the key features of the offset scheme in New South Wales and then some of the key challenges that we have in implementing that scheme. New South Wales is a state jurisdiction and we have a comprehensive and regulated biodiversity offset scheme that's established under the Biodiversity Conservation Act. And the Act provides for how impacts on biodiversity are assessed and consideration of whether development can proceed is then made under our Planning Act. Part of the regulatory framework that's set out under the Biodiversity Conservation Act embeds the mitigation hierarchy, and that means that developments that are assessed under the scheme are required to consider and demonstrate that they've taken measures to avoid and minimise impacts on biodiversity. The scheme's used to assess impacts on a range of development, from small residential through to strategic land releases, also mining, renewable energy projects, and also linear infrastructure. The scheme's also endorsed under our national laws for assessing impacts on species and ecological communities that are assessed as or have been listed as matters of national environmental significance. And this is really important because it streamlines the assessment approach that proponents who require both Commonwealth and state approvals, and so kind of creates that one-stop shop for those kinds of projects. The scheme is market-based and it's designed so that proponents can use market-based mechanisms to meet their offset obligation. And in this, proponents have options on how they can source the required credits, which is to either establish their own offset site, or they can buy their credits off the open market, or they can also pay into the Biodiversity Conservation Fund. And that fund is managed by the Biodiversity Conservation Trust, and the trust then takes on that offset obligation and will look to source and retire the credits that were required for the development. Under the scheme, offsets are described by a class of biodiversity credits, and a class of credits can be assigned to an ecological community or to a single threatened flora or fauna species. The class of credits typically has a range of attributes, and the matching of these attributes define the like-for-like offset rules. The attributes typically will define the type of community, its level of threat, and in New South Wales it's vulnerable, endangered or critically endangered, and also the geographical region from where offsets can be sourced. So it kind of limits the trading that can happen from east to west in New South Wales, which is from the coast moving inland. Fungibility of communities and groups of similar PCTs has had a number of iterations through the progression of the offset scheme, and the current scheme uses this concept of offset trading groups, and that's intended that is to create fungible clusters of PCTs that are interchangeable with each other. And at the time of this presentation, the total market value of trades in biodiversity credits is closing in on $450 million. moving on to the biodiversity assessment method. The current scheme has been in operation since 2017. Its origins date back more than 15 years ago, and the development of the biobanking program. Biobanking was a voluntary and a program, and the method, the biobanking assessment method, was typically a site-based method. And then as the scheme evolved, we progressed to developing a landscape scale method, and then in further evolutions, a method that was typically applied for state significant development and state significant infrastructure projects. With the development of the new scheme, it gave the opportunity to rigorously evaluate the best parts of the old method, and we created one single approach that is fit for purpose and applicable to the range of contexts and scales that I described earlier. The BAM has 3 stages, and stage 1 is essentially sets out how you assess a development site or an offset site, and so it's really the categorizing of the different types of biodiversity, the methods that you apply to measure those, and it's kind of like the inventory of what's on your site. Stage 2 is typically the development impact assessment takes place, and that's where the avoid, minimise and offsetting space plays out. It also allows for assessment of what's called prescribed impacts. So they're impacts on threatened species and ecological communities that aren't related to vegetation. So it could be a roosting cave for bats. So impacts on those are assessed a little bit differently to the clearing of vegetation. And then stage 3 applies at offset sites. And at the offset site, the assessment method considers the starting condition, the types of threats, and the amount of gain that can be created from that site. And that gain is what is used to drive the creation of credits. At the offset site, the BAM also helps to define the management needs of the site, and also what actions are required to manage the site and whereabouts on the site they're required. The BAM includes a standard for no net loss, which is applied at a project level, and essentially that's retiring the number and class of biodiversity credits that's required for the residual impact on biodiversity. The BAM is required to be applied by people who are accredited, and so that's typically ecologists, and who've got a number of years of field experience, and then they go through a training program on the assessment method and the scheme, and they get 3 years of accreditation, which is obviously renewable. And we're just coming up to the first stage of the current scheme on renewing or preparing to renew the initial round of assessors. We've got around 430 accredited assessors across the state. Our offset sites, they're secured and funded and managed. So kind of 3 essential elements that you should have for how offset sites are treated. And in New South Wales, they're secured under a biodiversity stewardship agreement, and secured means it's registered on title, so it's in perpetuity, and there's provisions in the Act that if that property is sold, then the agreement runs with the land, so it appears on land title certificates. The agreement to the implementation of the management plan, so the management plan is tailored so it's site specific, and it's the plan for controlling and ameliorating any threats to the biodiversity, and so it comes with a suite of management actions that are applied on an annual basis, and the funding for applying those management actions comes through the sale of credits. So when initial credit sales occur from that site, the first portion of those credit sales goes into a trust fund that's administered by the Biodiversity Conservation Trust, and then the landholder then receives an annual payment from the BCT, which provides for that ongoing management of the site. So offset agreements or biodiversity stewardship agreements are administered by the trust, and currently we've got around 205 agreements in place across the state, and that covers around 25,000 hectares of land. Key challenges, there's probably agree with everything that our earlier speakers have said, but I'll just describe those from the New South Wales context. And as many of you know, biodiversity offsets can be a contested space across different competing social and ecological and political perspectives. And certainly the experience in New South Wales has been no different. But we've also been fortunate that we've had the support of both of our major political parties, and that's provided stability for the scheme to grow and expand from a voluntary scheme under biobanking into what's now more mandatory for projects that are above a certain significant impact on biodiversity. And really, the language that we talk now is in biodiversity credits, and it's broadly accepted that the compensation for the loss of biodiversity is in the form of a biodiversity offset. And and then it comes down to the rules of how much and where and costs and those kinds of things. So the first key challenge, just pointing out, and I think it's Conor made some good points on this earlier, which is around change management, and allowing for and thinking through change management should really be a critical element of your program delivery. Through the period of regulated approach to offsetting in New South Wales, we've made a number of improvements to the assessment method. And in biobanking, I think we had over the 10 or 12 years that was in place, we had 3 updates to the assessment method, and then we transitioned to a new scheme that has a mandatory application. And so there was, we've benefited greatly from that approach. It's allowed for that continual improvement in the method, systems and data. And those kinds of changes are really important for the scheme integrity and ensuring that you're optimising the biodiversity outcomes that are achieved, because really that's what the intent of the scheme is about. But it's really important to understand how those changes impact your stakeholders, and doing stakeholder impact analysis ahead of that, and developing those transition and change management processes to assist with that implementation for those, so you can get those improvements implemented. Otherwise, there's the potential to create uncertainty and introduce risks and time delays at both the demand and supply side. I'd also advocate for investing in management systems and data to support implementation of your scheme as a key pillar of the program. And the use of systems brings integrity to the assessment and governance to the various transactions that occur. And it also can assist users navigate their way through those various touch points of the scheme, and particularly in relation to the availability and status of the different credit types. The BAM, or the assessment method here, is underpinned by the best data that we have on the ecology and management needs and distribution of threatened flora, fauna and ecological communities. And the BAM condition score is also referenced against a benchmark for that community. So we're really strong reliance on existing data, which also can help with the implementation of the assessment method, and which is essentially it's a rapid assessment, and so relying on that on good quality data is really important. But it's also we spend a lot of money on getting assessors out into the field and collecting data, and designing your management systems so that they're joined up to allow that the supporting data sets to allow that reuse of field survey data, so that it comes back into the systems, and our scientists can then use that information for the further development of of our plant community classification, or knowledge, use that knowledge on the distribution and population sizes of species. And so it's that kind of adage of collect it once but reuse it many times, because the biggest cost is getting people out in the field to collect it. Credit supply, credit pricing and market information is also a really critical element, and adequate credit supply, particularly of the right credit types in the right location, has been an ongoing challenge for us. And while the scheme is market-based, we typically experience a lack of depth across the market with low or little credit trade activity for many of the different credit classes and regions. The new scheme includes an option that allows proponents to meet all or part of their offset obligation by paying into the Biodiversity Conservation Fund, and the trust then has the obligation to find and retire those credits. And while the intent of that element is sound, it's also been very challenging to implement, particularly for those less actively traded credit classes. And while credit classes that are actively traded, we can use that trade history, and the economists use an econometric model for defining what that price is to pay into the fund. We're looking at new options for new developer charge models for credit classes that are less actively traded. Finally, capacity building across stakeholder groups is also really important. And again, some of the earlier speakers iterated that, the need for that engagement. And certainly, yeah, in New South Wales, it's been a really key challenge for us. And with the relationship of the scheme to the Planning Act, our local government is now one of the decision makers in the scheme, and that's the third level of government in New South Wales. And so there's a lot of effort goes into supporting and capacity building across local government. Similarly with proponents and assessors, we have training programs for assessors, and we've recently updated that the training program. And through I guess one of the benefits of COVID, if you can call COVID a benefit, but it's been putting a whole lot of training material online, and that's now becoming accessible for those other stakeholder groups across the scheme, and whether that's investment houses looking at investing in the scheme for creating credit classes or credit supply, or for proponents, it gives us that ability to target those groups that we haven't so much targeted in the past. But there's a lot of touch points that happen from go to woe across the scheme, and building that understanding of how the scheme operates and what those touch points are and how to navigate through is a really key challenge, because there's regularly new people coming in and into the scheme who might only interact with it for one particular development, and then there's obviously the larger developers that get quite adept at knowing how to navigate through and getting the best outcomes that they can get. So that's pretty much what I had to run through, and happy to answer any further questions that you have. I think Dave's going to come back on and set up for the next section.
Thanks, John. And you covered a lot of ground with a single slide there. I'd like to invite all our speakers to come back on screen, and we'll have a panel discussion and look at some of the questions that have come in from the audience.
Okay, I think everyone's here. So what we're going to do is we've got about 20 minutes left, minus some time at the end for wrap up. So we'll just do a round of questions. If we could keep responses to a minute or so per speaker, then we should have more time for questions. So I've got a couple of predefined questions that we identified ahead of time, and I see some questions coming in from the audience already. So we'll be sure to cover as much as we possibly can. So if you could each speak to what the key institutional structures that are needed to support the introduction of offset credit banking and what other enablers are also important from your perspective. We'll start with George and then go to Conor, Marianne, and then John to speak to that.
Thank you, Amy. And I would say when you look at these markets, there are three elements: the regulatory, market, and technical side of the equation, and they all interlap. But one of the things that are really important from the U.S. perspective is this construct of creating an interagency review team that creates a process for approval. And that interagency review team includes the main group, the Army Corps of Engineers, that regulates the national approach. And then you have state agencies and Fish and Wildlife also weighing in. And through that IRT process, it creates a great institutional approach for approving particularly mitigation banks, but any mitigation and in lieu fees. Another thing is templates. Templates for mitigation banks, templates for easements, templates for crediting protocols in each of the regions are so important because it enables not just the enterprise that's proposing a solution, but also all those that follow. Finally, and I know we're keeping this to a minute, is this idea of transparency. And in the United States, we have something called RIBITs, which actually creates market transparency. So we're able to analyze each state, how many mitigation banks are there, how many credits they have released. We're actually able to look at a data depository through cyber information of that bank. So when a buyer and seller decide to talk to each other, that buyer can look up that particular seller's project and know whether there's credits released, whether it's still valid, and get more information about the banks. And I'll leave it at that, Amy, and turn it over to you.
George, would you like to add to that, Conor?
Yeah, I think definitely second everything George just said there. The two other items I would add to that are making sure that the regulatory agencies in charge of overseeing the programs have enough staff. So a lot of instances where permits take a long time, quite simply because a certain regulatory agency doesn't have enough staff to review the permits for the mitigation banks on a timely manner. So they need to make sure that the staff is in place. Secondly, I think we need to leverage technology much better than we currently are. John, fascinated to hear about what you guys are doing there and would like to learn more. I think George mentioned RIBITs. When you really dig into the detail of the data in RIBITs, there's quite a few data integrity problems, or just people not always entering data or forgetting to enter data or not entering it uniformly. So it's a very powerful tool. It works well. It could work a lot better. And I think just moving forward, leveraging technology to really allow for transparent access to quality data is just critical to these markets getting super robust. And I think some agencies should probably consider looking at public-private partnerships to do that. It can be so difficult to get heads approved with the sort of political context these days that sometimes it can be better done if done through partnership.
Thank you, Conor. Insightful. John?
Yeah. Look, I think for us, I mentioned the stable political environment that the scheme has operated in, and I guess under that we've probably had. Won't try and count the number of different ministers that we've had, and then from an agency's perspective, the kinds of changes that we get with restructures and the like, and so having some core institutions is really important for that that delivery, and the creation of the Biodiversity Conservation Trust, I think, is a really good structure to have for administering the ongoing administration of the offset sites, and then I think Conor's point about sufficient staff to resource it is really important as well. And certainly one of the other elements I had was capacity building, and that's just not just of external people, but within the agency and that knowledge of the scheme, and can really help to smooth that implementation. Thanks, Amy.
And Marianne, would you like to add to that?
Yeah, actually, I really want to stress again the point, or one point that Conor made, that you really should not underestimate the need for administrative capacity, and not only in the let's say in approval of the credits, etc., but also, and that's something where we in the German system still have problems with, is to have enough administrative capacity also for monitoring and follow up, and to really run these registries so that they are really up to date, and so that everyone can have a look at it. So that's really, really important. And I would even say that often with these different credit systems, people put a lot of efforts in putting a very solid methodology in place, but they think too little about this implementation, which is so very crucial. And the point that I made earlier that I would like to add or stress again is also about people, but not on the administrative side, but as I said, to build regional or local partnerships to get people on board. This sounds trivial, but really in implementation, this is really helping you a lot for good outcomes.
Thank you, Marianne. That's fantastic. I'll do another round here with a question from the audience. What are the mechanisms for ensuring that funds are available for the long-term sustainability of mitigation sites? What has worked well and what has not worked so well? George, could you get us started? And again, we'll try and do about a minute per response.
Yes, and in the U.S., under the 2008 mitigation rule, they just promoted this idea of long-term stewardship, which had been embraced in our Endangered Species Act for years. And one of the tools that has been very successful in that approach is this idea of endowing the long-term stewardship. So not only do you, when you charge for a price of a credit, do you include the activities that you're dealing with, but also the price of land for restricting that land use, but also the long-term stewardship. And so what has happened, there's these methodologies, one's called FAR, that basically looks at analyzing the management costs tied to a management plan over a 30-year period, let's say, and then ultimately takes in an approach with a discount value to figure out what that endowment should be. And then you build that into the price of the credit. And the idea is that that endowment has to be funded by the time within 4 years of your first credit sale. And that's been a very successful approach. Can make the credits a lot more expensive, but make sure that there's endowment to cover that long-term stewardship.
Thanks, George. Conor?
Yeah, George explained the mechanism here in the U.S. very well. I think the one point I would add to that is this is one of those areas that's really interesting right now, and there's a lot of discussion within the implementation side of the industry between implementing parties and the regulators, and this is where you get into some of that bioeconomists, right, of what are they going to look for in that long-term monitoring plan? What do they think it's going to cost versus what is the implementing entity going to say it's going to cost? And, you can get into some pretty in-depth discussions on, are we going to have to fix a structure every time it fails, or are we looking at something else? Because those have two very different costs when you're analyzing them. And if the regulators, this is one of those areas where perfect versus good, it's never going to be perfect, but let's work for good. And there's different factors to consider in evaluating what those costs are going to be, and different bankers are going to do it differently. And if the regulators try and make it uniform, that can negatively impact some people. And I think, to George's point, is the regulators get more conservative as to what they think that long-term risk profile is and how much it's going to cost. Ultimately, that's going to impact credit prices, and they need to make sure from an enforcement standpoint that they're holding in lieu fee programs to the same standard. So it's the mechanism we have in place is a great mechanism. There's a lot of discussion around it right now. It has pretty significant impacts on pricing, and it's one of those areas that we just have to keep going back to and revisiting and tweaking as we move forward and looking to make the program better.
Thanks, Conor. And Marianne?
Yeah, basically, what we've seen in Germany, that it's really a question of experience in the more mature offset banker or provider with the more experienced offset providers. We've seen that usually, to put it very bluntly, you have a, say, nature or biodiversity guy, and you have a money or economics guy, and with experience, they have developed very adapted pricing systems where they calculate also the risks and the long-term management and monitoring into those plans. And they showed me their different calculation schemes, and even the factor time is not the most important one, because after a while the curve really is going almost flat. They said if you calculate for 40 years, you can also calculate for a longer period. So that's the one thing. And the other, so that works pretty well with the trained professionals. And the other thing is what you do, and I think there was also a question from the audience on the maybe bankruptcy, or if developers go out of funds. In Germany, often this is avoided by putting the measures in a nature conservation fund, which is under a public entity, which ensures then that especially the land, but also the measures are exempt from this risk. So that's something that has been used vastly in Germany and seems to work quite well.
Thanks, Marianne. And John, would you like to add from the perspective of New South Wales?
Yeah. I think one of the most challenging parts for a landholder entering into setting up a stewardship agreement is working out what the management costs are going to be, and because they kind of looking out 20 years and beyond, and the range of different events or unforeseen events that could come up at that time. And so we've got some approaches that help do that, and that establishes that overall management cost that goes into the stewardship payments fund, and and part of that is getting those costs to net present value. So there's a discount rate that sits as part of determining what that figure is. And some of the challenges that we get in that space is with some unforeseen events. You no doubt would have heard about the bushfire season that we had, that the word unprecedented was used an unprecedented amount of times, and some of the sites were burnt in through that. So that kind of changes the profile of how those payments happen. But in terms of how those funds are secured, each stewardship site has an account, and the funds are invested, and so they're earning as investment earnings are what ensure that those payments can continue on. And there's some provisions in the Act for operational deficits or surpluses, and that's there was another key point I was wanting to make. There was the sites become active once that trust fund deposit or the total fund deposit has been fully met. So that's 100% of the expected management costs have been paid in. And so we can have some sites that sit in passive. So the terms of the agreement still apply, but actively managing it for getting those gains in biodiversity may not be being realised. So there's some temporal losses that could occur in that time. One other point, Amy, really quick one, is
Sure.
we also get pressure from some of the larger land managers that if they're looking to offset on their own, on land that they own, they often challenge us to say that they can manage it cheaper because the way the regulatory framework is set up, they have to pay into the fund, and then they get those payments back over time. And yeah, and so some of those larger players challenge that concept to say that, why do we have to commit $1 million into the trust fund when we can be doing that a whole lot cheaper ourselves and progressively.
Thanks for that, John. So we've got just a few minutes here. I've got to make a quick closing comment, and then Dave will too. So we'll do one more because I think it's very appropriate for the Canadian context. And if we could just keep our responses even more like 30 seconds for this round, we should be able to end on time. So the question is, what is the ownership of land where the banks are used in each of your jurisdictions? So are they exclusively private, or is it possible to have the public banks established on public lands as well? And that's particularly relevant to the Canadian context because we have so much what we call crown land in Canada. George, if you could get us started, that'd be great.
Yeah, and I worked on this issue in Canada a couple of years ago on crown land. You can extract timber and mine, but you can't conserve very easily. And in the U.S., most of the mitigation is done on private land, but you are eligible to do it on public land so long as that public land already doesn't protect for the purposes that you're intending. And I think it's a really important issue, and it becomes a little bit cloudy. The other points to raise is you've got to understand each of those land management groups, whether it's the U.S. Forest Service, the BLM, or others, and their particular approach and templates about how you work. They have their own land use plans. They have restrictions on how you do tenureship and restrict the land. And the final thing is sometimes they don't charge enough. And what that will do is if you allow this to happen on public lands, you could undercut the private market because you're not charging enough for the underlying land use, and then there'll be a rush to the public land. So we're evolving in the U.S. This is a hot topic, but it is eligible under those constraints I mentioned.
Thank you, George. Conor, anything to add there from the U.S. perspective?
George covered it pretty well. I think this is a pretty hot button issue for me personally. The only thing I'd add to that is the other way to view it is either having a credit deficit for work that's done on public land or a credit bonus for work that brings new private land into conservation. For those people out there who argue that, we shouldn't do any of this because maybe we don't understand the restoration science well enough, et cetera, et cetera. By bringing new land under preservation, we are increasing that net good. And even if you miss on your restoration mark, still long-term, that's going to be newly preserved land. So very, very hot topic discussion here. And I think George covered all the main points, but the other way to think about it is in your crediting scheme.
Thanks, George. Marianne?
Yeah, as I said, I can be very brief on this one, that in Germany, it actually started on public land. So from my perspective, this is very well possible. But of course, this means that you have to take into consideration some circumstances. This is then obviously more like a regulated market, and you have to deal with potential inequalities, as George has mentioned. And the most important thing there is to stress again that you should focus on additionality, so that you cannot, use land twice or whatever. So that's really crucial. But taking this into consideration means that you can, of course, do it also on public land.
Excellent. And John?
Yeah, look, we allow both public and private land for establishing as offset sites. On public land, that does exclude national parks, but for the remainder of public land, there's additionality is taken into account. So they're already required to maintain that crown land at a certain level. So there's a reduction in the number of credits that can be created. But we have local government have established sites on crown land, and yeah, so it plays out on both, but certainly the majority is on private land.
Great, thank you for that. I think that's helpful perspective for us here in Canada. So we're down to the final seconds here. I'll invite Dave to join me on the stage and ask our speakers to leave, but I want to express my sincere thanks to the audience for submitting their excellent questions, and great thanks to our speakers for taking time and energy for us today, especially given the time differences. It's now the next day where Marianne is, and very early in the morning where John is, and it's a statutory holiday in the US. So this was no easy feat. We appreciate you and the energy and time that you've taken with us today. And if you could exit, and Dave, I'll let you take it from here.
Thank you, Amy. And Leanne, let me repeat the sincere thanks to all our speakers. They really went above and beyond in terms of showing their commitment to being with us, and given their various circumstances. And thank you to you too, Amy, because you've done a tremendous job in helping to pull this together. As well, I'd like to extend my thanks to our partners and sponsors, Alberta Innovates, Government of Canada, Social Sciences and Humanities Research Council, ConocoPhillips Canada, and Tech. And of course, I would like to personally thank my ALI colleagues, especially Kathleen, for all the work they've put into pulling this series together and helping with all the technical glitches right up to moment by moment. Finally, if you've not already done so, I encourage you to check out and register for the remaining sessions in this 8-part series. Our next session will be June 7th, when we will be drawing back our lens with a panel to discuss ecosystem services and market-based instruments. The session will be led by James Salzman, and we'll be hearing from Jillian Kerr, Carmen Cantuaria Sevilla Suzanne, Christopher Wally Wright, and Paige Olmstead. Thank you again for joining us today.